Hello, everybody, and welcome to the Crypto Hipster Podcast. This is your host, Jamil Hassan, the Crypto Hipster, where I interview founders, entrepreneurs, executives, thought leaders, amazing people all around the world of crypto and blockchain globally. And today I have an amazing guest. Why? Because he's a repeat guest. I had him on the show back in 2004, in February of 04. And I'm looking forward to this conversation today. I have the co-founder of Haven One, Jeff Owens. Jeff, welcome back.
Yeah, thanks for having me, Jamil. It's been a pleasure to be on and looking forward to this conversation again.
Me too. And I can guarantee you that last time we didn't have any viewers for the show. Why? Because my show back then was audio only, and in the past year I've made it video, and people like the video, so I do both versions. So welcome back. So let's kick things off. And for people who didn't watch the show the first time, because they couldn't, what is your background, and is a logical background for what you're doing now?
Yeah, so my background is in engineering and design. So I actually had a dual degree coming out of university, but I actually built companies since I was in high school. So I call myself a serial entrepreneur in pretty much every field. So I've gone from healthcare to e-commerce to parking, and everything in between. So, and then crypto, obviously, since 2015 is my largest background. So I started in crypto as a private investor, actually using some of the capital from one of my exits that I've had. And actually, I really wasn't a huge fan of Bitcoin early on when I heard about it. And I wish that I was back then, and I had put some money into that as well. But really, I liked the concept of Ethereum and smart contract idea of actually creating utility around the blockchain itself and not just having it be a store of value. And so that's really where I started my investments off back then. And then kind of just played around the space, looked at a lot of different things and projects that people were working on. And then I actually built a company called Coinbag, which is a digital asset management tool, which originally started as essentially a robo-advisor, because I saw oftentimes in the space a lot of people were coming into crypto, and the barrier to entry from a user experience standpoint was quite high. And we actually ended up pivoting because that was a little bit too ahead of its time into offering these basically same services to make blockchain easier and the storage of digital assets easier for businesses. And so that's actually where I met my co-founder of Haven One. He's actually a client of ours. So he is running a $250 million fully DeFi fund, and we're just looking at the landscape of crypto. And I obviously, with Coinbag, had many different institutional clients in the family office space and in different sorts of securities platforms. And a lot of them were just holding crypto on their balance sheets. And I was looking at my now co-founder and how he was managing crypto on chain and the risk management processes that he had, the tools that he was running everything through. And I realized that there's this massive disconnect of like real utility of institutions coming into the blockchain space. And there was a huge knowledge gap of what was needed to effectively deploy capital on chain. And so we started looking at what he was doing effectively to not lose capital on chain. Then we started talking to many other DeFi asset managers, and we realized that there was a lot of overlaps of tools that people were using. And everything was essentially preventative and reactive. And this is where we actually wanted to kind of change the game with Haven One. And we found a pretty decent size opportunity to service a permission blockchain to institutions looking to come into the space. And the permission nature of the blockchain, we use it as a tool to offer things like instant finality and gasless transactions, which is important for scale. But from a security standpoint, we can layer in a lot of these tools into the blockchain itself. So we have, for example, anomaly and threat detection models in place in partnership with some of the largest like threat prevention partners out there, like Hypernative, for example. And these tools all come for free to institutions looking to deploy capital on chain. They get that out of the box. It does AML screening. It does anomaly detection. And on top of that, we can also layer in things like two-factor authentication and bring more legitimacy to the builders in this space. Like one of the largest attack vectors in this space today in permissionless ecosystems is the fact that anybody can spin up a node and deploy a smart contract on chain. And that is a ton of power, and unfortunately has not been used for good in the past. And so with Haven One, we do have permission smart contract deployments, so it brings more of a funnel to the deployment, and not everybody can come in and deploy. You have to go through KYB, verification, furnish audits. And really for us, it's more about quality over quantity. And we're looking at ourselves as kind of the next phase of blockchain adoption for some of these institutions, while still offering the full suite of all products that are out there. A lot of institutional products have failed in the past because they're too siloed. Like Aave Arc famously failed because they were way too siloed. And so for us, we have a lending market, we have a perpetuals market coming soon, we have a swap product, we're integrating a request for quote and prime brokerage essentially on chain. All these types of things give you all the benefits of a blockchain while the security of more of these like CeFi type of products.
Very cool. So that's why Haven is what's your your long-term vision, your mission, person. What do you see as the long-term look of DeFi and how you're going to help make that happen?
Yeah, I mean, for me, there's the like I've been in this space a long time. So there's the idealist thought of like be your own bank and all these things of self-custody and decentralization. And the more that I've started building this space, the more nuanced I've realized that is, and the more trade-offs that I've realized occur with those types of things. And in particular, it's a huge issue that we're seeing in the space today, which is it's very, very difficult to attract new liquidity into the ecosystems. Why? Because of the security aspects. So when we're talking to a lot of these institutions that have tons of access to TradeFi institutions, we're talking like WorldPay, who has 3 trillion, they process 3 trillion transactions annually. PaySafe, they have 20 million users in their Skrill wallet. None of these users are actually interacting with crypto in a meaningful way today because the risks are too high. They're typically using centralized products for this. And so my vision is to give that same type of security principles that centralized type of products offer, while still offering the services on chain and still remaining decentralized enough. And so that's really my vision with Haven One. And you'll see that through a lot of our marketing materials is like decentralized enough or sufficiently decentralized. And the way that we do this is by having a curated set of validators that act as essentially the ecosystem guardians. And that number will grow over time. It's 9 today, and that number will grow up over time. They're large tier 1 institutions. And so for me, really to round this out, like my vision of this is to essentially try to attract new liquidity that otherwise is too scared to come into crypto today, into crypto. Yeah. So essentially, in a lot of our marketing materials, we have permissioned enough or sufficiently decentralized. And I think this is a question that oftentimes comes up because when you look at like L2s, people assume that they're decentralized, but oftentimes they're not. They're usually managed through centralized sequencers that have a few people controlling a multi-sig wallet. Yet people are thinking that because it's built as a layer 2 on top of Ethereum, that's decentralized. And you can actually make the argument that Ethereum's not that decentralized either. And so for us, the way that we handle decentralization is that we have 9 tier 1 large institutions that everybody knows: WorldPay, PaySafe, Bitcoin Swiss, just to name a few. And they're the ones that help decentralize the network, and they act as the guardians and gatekeepers of the network as validators. And that number will grow over time. And so ultimately for us, like I say all this because it's just an example of the nuances that occur in this space. And I think people oftentimes confuse decentralization and permissioned as being one and the same thing, or I guess 2 different things. And I would not say that decentralized means permissioned and permissionless doesn't mean decentralized. So that's something that I think is an important point for people to understand. And so, to round it out, essentially what I'm looking at with Haven One and what our objective is, which takes time because institutions move very, very slow, but once you get them, it's sticky capital, is our mission is to essentially build a product that allows new capital to come in a meaningful way. And this is through essentially DeFi and RWAs.
Got it. So, yeah, so I want to dive that. There is a stigma about permissioned blockchains. And the stigma is they're not effective. And think of you think of IBM, which works, Hyperledger works. But you think of other companies like consulting firms that created their own editable blockchain that did not go over too well, right? So how do you get past that, misnomer or stigma of permissioned equals ineffective?
Yeah, it's probably the hardest thing that we deal with from a marketing standpoint. I mean, I think the idea with the Haven One network, and I know the idea with the Haven One network is defining those rules of what is permissioned mean within our ecosystem. And so when you look at like IBM or you look at a lot of these other blockchains, they're purpose-built blockchains that are essentially built for that single institution. and they have a very specific use case that they want to employ. And it works really well for that use case, but it doesn't work at large scales of economy. And oftentimes we've seen this already, like Haven One is a fork of GoQuorum. GoQuorum was originally built by JP Morgan, sold to Consensus and open source. We worked with the guys that actually built this at JP Morgan, and we've learned a lot of reasons as to why. One of them primarily being that if you have a single institution that is owning the blockchain, most other large institutions aren't going to want to go and use that blockchain. They feel that they're giving up a piece of their pie to that competitor. And so Haven One aims to kind of be that intermediary that works with independently all these different institutions spread globally that put together business cases to essentially try to grow the ecosystem within Haven One. So, for example, WorldPay is looking to do treasury management in DeFi on Haven One. PaySafe is looking to integrate the Haven One network's DeFi into their wallet. These are the types of use cases that the validators bring to Haven One. And it's not just a single use case or a single, it's essentially purpose built to bring and gather large scale institutions to come in without being favored towards one or the other.
Got it. Okay. All right. Sounds good. So we spoke, and I want to get into this liquidity issue too. So I'm going to circle that and make sure I don't forget that. But we spoke back when all the companies were building DeFi 1, right? 1.0. Now, Eric, all the companies are building DeFi 2.0. So how does DeFi 2.0 differ than DeFi 1.0, and what is DeFi going to look like in the next year or so?
Yeah, so I think the consensus definition of DeFi 2.0 is integrating RWAs into DeFi. So being able to use things like tokenized T-bills, which most products, both banks as well as large-scale stablecoins are already purchasing, and that's how they make quite a bit of money. Offering the ability for the everyday consumer as well as large institutions to park their money in tokenized T-bills. And then what's great with DeFi is that you can take those T-bills and you can use them as collateral in different lending markets, to use DeFi looping to offer more competitive yields than what you would otherwise receive in something like a high yield bank account. And so these are relatively decent risk adjusted returns because they're relatively stable assets and you don't put high leverage against them. And so that's, I think, the consensus idea of what DeFi 2.0 is. Haven One looks at DeFi 2.0 as another layer of security and protection. And so I think one of these things that oftentimes is not looked at favorably when you're talking to OG crypto people is compliance and KYC and KYB. But unfortunately, it's a non-negotiable for a lot of these institutions that are coming into this space. And so you're seeing a lot more people. I mean, the Genius Act, for example, is put this out front and center that a lot of stablecoin transactions will have to have KYC and identity tied to them. And so it's not something that I think we can hide from anymore. And Haven One has kind of seen this for a long time. And our objective was to skate to where the puck was going and not to where it is. And that's why we essentially baked in KYC as a framework into our ecosystem. It's not required to interact with the network itself, but different applications and specifically different assets can elect what KYC and KYB levels are required. So an example of this in terms of DeFi 2.0 isn't just about being able to purchase a tokenized T-bill and or put your money into a vault that has a DeFi looping strategy against that tokenized T-bill. DeFi 2.0, in our opinion, should also layer in compliance and KYC to offer better yielded, higher risk products to users of these types of products. And so there are certain vaults. I mean, like we've seen this happen with Base, where Base is now layering permissioning into their blockchain as well. There's a reason why this is happening, right? Like if you really want to bring in new liquidity into the space, you need to do that. And so, yeah, that's in my opinion, kind of the unspoken aspect because it's kind of frowned upon in crypto. And once again, these things are like, I'm not saying that this is where all the liquidity is going to flow and this is where all the users are going to go to. In fact, it's going to be quite the opposite. What's the beauty of Haven One is that it should be complementary to a lot of these permissionless ecosystems. And we really are purpose built for these new types of liquidity to come in.
Got it. And the high yield savings account at a bank never made any sense to me if I could buy T-bills and get the 4% rate. But then if I buy a crypto stablecoin, I want better than a 4% rate because I can put it into T-bills instead, right? So, it's a catch-22 or 24 or whatever you say, but you're
I mean, and on that note, I mean, that's one of the beauties of crypto is that I don't think purchasing tokenized T-bills directly makes a ton of sense. Like you just go and do this in traditional markets. But if you can offer someone 6 to 7% instead of 4% with the same risk-adjusted returns, because they aren't levering up the position, they're using it as a single-sided lending market. People are borrowing against it and paying for interest on that. Like that's something that then gets people excited to move their money out of the 4% into the 6 to 7%. And when you're talking large scale, like those numbers are huge. I mean, that's a huge difference. Right? You're looking at almost it's a 50 to 60% increase in interest rates without actually changing any sort of risk parameters around it, which is what crypto can do. Right? Like that's something that is well proven, and Aave is a great example of this.
Yeah, I agree. So, that's retail liquidity. Let's talk about institutional liquidity, right? We're having a hard time getting new, like you see, like the past week there was a pullback. Some cryptos did okay. I'm not going to mention the names. They hung in there. A lot of things dropped. But it's liquidity, and I'm like, it's the end of September. Companies are playing on their 10Q, whatever. And there's going to be more liquidity, but it's a rotating game. Like, how do you get permanent large institutional liquidity, thrust into the market? How do you get there?
Well, this is where you need to have stable coins as a primary driver for this, and actually interest products around these stable coins, because stable coins requires a significant less amount of rebalancing. Where if like you're doing, like, let's say you're holding Bitcoin on your treasury, like, and Bitcoin goes up 20, 30, 40%, you may have a mandate to rebalance that out. And so that actually could draw out liquidity in this space. And so that's like why, like, if you talk about like asset prices versus like TVL, they should be decoupled over time. And actually, hopefully, ecosystems that have the ability to create productive monetary TVL around stablecoins should be in the strongest position, because the other issue that's kind of unspoken in crypto today for the average consumer is that most TVL that sits in blockchains is not productive TVL. It's mercenary capital that they're paying, and it's basically USDT, USDC stablecoin that the blockchain is paying tons of money to have that liquidity sitting there, and nobody's actually using it. Trading volumes are 5 bips maybe on the spreads there, and people aren't oftentimes swapping USDC to USDT. So there isn't a ton of value there. Not only that, like the economics of the blockchain typically aren't monetizing off of that. The protocols are. And so that's another problem to discuss, and why I think Hyperliquid as well as Haven One are kind of shifting that model. Berachain is in theory doing this as well. Yeah, like the goal is to like get out of the real productive TVL being these super volatile assets. Like the way that blockchains make money today is that people put in ETH USD liquidity, or they put BTC USD liquidity in. And the reason why is that allows for discrepancies to create arbitrage opportunities, which creates more trading volumes. And the cost there, though, is that when you have super volatile liquidity like BTC and ETH is your necessity in order to actually monetize in a blockchain and or a protocol level, you're much more susceptible to institutions coming and pulling money to do rebalancings and all this type of stuff, and maybe pivoting and making different decisions. Where if you can shift the narrative into, let's say, these tokenized T-bill vaults that are earning 6 to 7%, the money is going to be much stickier because it acts like a savings account. People aren't sitting there trying to rebalance that capital. It's actually there to sit there and accrue interest over time and potentially be used to pay off some of the stuff. So you're just losing potentially the interest off the top of that rather than the baseline asset, because it actually affects your overall returns. So those are some of my thoughts within the ecosystem of what I think needs to shift for us to see less of these like massive liquidity pullbacks that we see. But in terms of like price impact on this stuff, this is going to be there for the foreseeable future. Like institutions definitely help with some stability, but you'll also see that if they start to take leverage positions, it actually could create significantly more volatility than people expect.
Yeah. Well, actually, I actually understood all that. So very cool. Thank you. You mentioned that you're approaching RWAs a little differently than most other RWA focused projects. So how are you different?
So I think in general, a lot of RWAs are decoupled from DeFi itself. So you see a lot of times that RWAs kind of sit in their silo. And so for us, RWAs is an integral piece to the DeFi 2.0 ecosystem. So but that also includes having things like perpetuals protocols, having things like basic swap and high liquid assets through RFQ products, while also being able to use these types of RWAs to create multi-strategy vaults that go beyond just the 6 to 7% interest. Because the next phase of this, if you want to bring in real private wealth, is not going to be just 6 to 7%. There's going to be people that want to put 10 to 15% into very high interest, high yield opportunities where there's maybe 20 to 30% of the vault is doing perpetuals strategies or hedging strategies. And then you have the other, 70% or 80% that's sitting in a tokenized T-bill doing just DeFi looping. Like, you need to have all these things symbiotically working together. That's where Haven One is essentially trying to approach this differently. And I think one thing that I also think is important to mention here is around just the general economics of the Haven One blockchain, which is essentially we've created the pillars of DeFi at the baseline of the network. So we have our own swap protocol, our own lending protocol, our own perpetuals protocol coming soon. Those are like the revenue powerhouses of most blockchains, and typically siphons of utility away from blockchains like Unichain and Uniswap. Over time is actually deterred from a lot of ETH price appreciation because it doesn't actually drive all that much utility in. Like, most of the revenue is actually generated into the Uniswap labs. And so that doesn't go back into Unichain and arguably into Unichain and or even back down into Ethereum. And so for us, why is this important with RWAs? Because if you're looking at the blockchain itself, we want the revenues from those core protocols to be really driving value to long-term ecosystem participants. So when you have somebody that gets liquidated in a perpetuals protocol, rather than it just being revenue that goes to Haven One that then sits in treasury, most of that revenue actually goes back into token buybacks, which then is then used for incentives for other products, which could be RWA products. So imagine that you have a tokenized T-bill product that has an extra 10 to 15% boost through H1 tokens over a 3 to 6 month period to drive in more liquidity, more awareness. If you can create longer term incentives that are actually driven by revenues in the blockchain and value of the blockchain rather than VC money, that should create a much more sustainable economic flywheel that allows you to create better pockets of incentivization, because that's essentially what we all are going to be battling, and why we aren't seeing huge products stick around for a long time in this day and age. Like, you have the OG guys, but you don't see a lot of new blockchains sticking around because they run out of VC money to incentivize people, and then the TVL is mercenary and it leads to the next protocol. So like I said, I compare ourselves economically to Hyperliquid. Obviously, Hyperliquid is much, much larger than us, but the economics are very, very similar, which is you take the revenues from these massive revenue generating protocols, and rather than giving them to a third party, you're using it to really incentivize long-term growth of the ecosystem. And so that's, I think, one of the things that we're doing differently in terms of RWAs, because it is all about incentives at the end of the day. If you're offering the same DeFi looping product as everybody else that's earning 5 to 7% interest, but you can offer a more sustainable 2 to 3% boost on that through H1 tokens, that becomes interesting to people again.
Yeah, I agree. I saw something I don't understand. Like, I don't understand how the flywheel works. Like, I'll give you an example with Solana. You got like 100,000 meme coin tokens. They're built on Solana, but you don't see the price and the value of Solana going up very quickly as it probably should, because you have all these products being built on it. So I don't understand how that all works. I would think it would be higher, but
it's a race to the bottom on that stuff, right? Because a lot of these L1s have economics that don't incentivize token price. Like, they hope people buy and stake their tokens, and that removes circulating supply. Maybe they have a few burn mechanisms in place, but when you're dealing with hundreds of thousands of meme tokens on your network, and the cost is next to nothing, it's pennies for the transaction, you're not making enough there. Like, you have to 100x your scale in order for actually to make people really need to buy that supply off the market to then pay for transactions. And then people don't want to use that blockchain, right? Like, so it's this like chicken and egg. Like, this is the Ethereum problem, right? Like, Ethereum has the gas fees that are range based on demand. And that, in theory, actually is good for ETH price, because if there's tons of congestion, ETH price goes up. People need to buy more ETH in order to actually pay for gas. Solana and a lot of these other blockchains don't have that problem. And so then what happens is then you just create less demand for the token. And so you have to find other ways in which you can create demand. Like I said, staking is the one that a lot of people like to do. But once again, where do those incentives come from? Burn mechanisms, you can have votes to have burns where you say a percentage of the transaction fees go to burns, which reduces the overall circulating supply. But a lot of these L1s need to find ways to actually generate real revenues. Now, Solana and these other ones don't have this problem either, though, because it's like most of their treasury is built off of speculation. And so speculation has driven them up into a value in which they will be able to stick around for a very, very, very long time because there's enough people behind it supporting it. And so there is this mantra with crypto, which is like you either have to go the hype route or you have to go extreme utility route. And so I think Hyperliquid's the only one that's done this extremely well in this day and age. Everyone else is really mostly on that hype train. And so this is why you see a lot of people posting things about partners and KOLs pushing tokens. And it's a lot of misaligned incentives ultimately and not a lot of delivery. And like it's the game that I think we're all in right now.
Yeah, that makes sense too. Thank you. So this is good. I'm learning the good stuff today. So you are helping companies move between Web2 and Web3. There's a chasm there. So some of the lessons that you learned, I'm interested to find out, when you're helping cross that chasm, and then what are some of those opportunities to still build within that, helping companies go from Web2 to Web3? What's the revenue generating opportunities that no one's looking at right now?
Yeah, so the hardest part with Web 2 to Web 3 is like just being very blunt on this. There isn't enough of a problem there. So Web 2 is solving, if you're talking like people that are in Web 2 that are holding crypto, that group in particular, I would say that most of the products that are out there today are solving their needs just as much as they need. And so there isn't a ton of demand there for them to move into Web3 unless you can start to incentivize them with better interest earning opportunities, things like that, right? Like you have to start offering better products to them that are more competitive than TradeFi today while being equally secure. When you talk about people that haven't been in crypto at all, that are Web2, like that have been in finance but are trying to get into crypto, there's just a very steep learning curve. Like you can build all the best wallet solutions, but like when you're talking about institutional adoption, not only do they move super, super slow, but like most people focus on retail-based like adoption. So if you look at like Sui and their Google sign-on wallets and like all that stuff is great for retail, but there isn't a lot of great solutions out there for institutions today. I mean, MPC wallets, you can make the argument, are doing this. A lot of institutions are still trying to figure out how that works, but that's probably the biggest hurdle today is that you get a lot of interest. A lot of people's minds are piqued, especially on the institutional side. I'll just talk on that because that's like really where our bread and butter is. But institutions just move slow. They move slow. They have massive risk departments. They play defense, not offense. When you're working with someone like, I actually won't drop any names. When you're working with very, very large partners that want to commit to doing something because there's a significant monetary opportunity there, you have to answer a million questions as to why. And as you should, right? Because like the worst thing that could happen to them is that they decide to do a pilot and then all of a sudden, poof, the money's gone, which unfortunately crypto has that mantra today, right? Like it exists everywhere, which is hacks, exploits are prevalent. And so that's their clients' money. That's their brand that they lose overnight. And the question is, how big is that opportunity? And frankly speaking, the opportunity hasn't been big enough yet for a lot of these companies to do that. And so that's the hardest barrier here, is just trying to get over those hurdles of risk, security that these institutions need to have, while still offering them products that are sexy enough for them as well as their clients to make the leap over. And so that's, I think, the sweet spot on this stuff. But yeah, you're talking like 6 to 8 months to get a blog post pushed out for some of these companies, right? Like,
yeah, that's true. I worked at AIG for a long time, so I can see, and I built databases, and I can see from a database perspective, it makes sense to be on a blockchain. But from a monetary perspective, it makes sense not to lose your client's money. So, L1s are not all L1s are quite ready for institutional adoption, including Bitcoin, right? At least the Bitcoin network, MicroStrategy's holding.
ETFs right? Like the ETFs are a very easy interface for people to be able to purchase without having to, like the person they trust is a custodian. The custodian they trust to have done all the security that they need to do. So that's, yeah, very, very similar on a lot of these things.
Yeah. So what's gonna make the L1s ready, or are they never gonna be ready?
Well, I think it's like if you look at something like Haven One, and I can only speak to Haven One and some of the conversations that we're having. There's two key things, which is time and market, and then the ability for them to actually adopt those solutions. And so, I think blockchains are getting ready, and I think that like when you look at Base is definitely ready to take on institutions, and it's built by an institution, so that's always helpful. Um, but it's a matter of time and market and getting these companies to actually be able to see the use cases there and then deploy. And like when you get a few of these use cases, they're not small, right? Like you're talking hundreds of millions of dollars potentially for a small pilot with some of these large companies. And so I don't think that we're far. I think that we're going to start seeing some major movements and probably at least announcements in 6 to 8 months. Which in crypto, that's forever, right? Like that's like I come from the traditional world for most of my other startups that I had, and like if you like have an exit within 5 years, that's considered a miracle. And in crypto, it's like you have to do that in a year and a half, or else you're a dead project. So, getting institutions to be able to have the pockets to be able to last long enough for institutions to adopt it is definitely a challenge. That's for sure.
Yeah, I agree. Well, I want to thank you for your time today. I want to thank you for coming back on the show. It's been an amazing conversation again. Appreciate it. And I have one last question for you. It's how can people find out more information about you, about Haven One? How can they start to use your platform? How can they do that?
Yeah, so go check us out at haven1.org. We actually just launched our lending market, so it's HLend. You can go to lend.haven1.org. And actually, everything can be accessed through the portal directly. So if you go to haven1.org, click enter Haven One on the top right, connect your wallet. You can play around with the swap protocols, our Earn product that we have, which does single-sided liquidity provisioning, which is a really cool product to check out. And then our lending market is the easiest way to earn interest natively in your crypto. And then we have a couple markets that are boosted through H1 rewards if you want more exposure there. We'll have that in place for probably 30 to 60 days, and then we'll allow the actual flywheel to take over, and incentives will drop down, and it'll be based on buybacks essentially going forward.
Awesome. Thank you very much for your time today.
Yeah, thanks, Jamil. I appreciate it.